The United States in Economic Crisis, a historical overview. The history of the United States is filled with economic highs and lows, moments of prosperity followed by periods of deep recessions and financial instability. Economic crises are a recurring theme in American history, each leaving a lasting impact on the nation's policies, institutions, and the lives of its citizens. From the Great Depression to the 2008 financial collapse and the ongoing economic challenges posed by inflation, the U.S. economy has proven to be both resilient and vulnerable. This video provides a historical overview of key economic crises in the United States, examining their causes, effects, and lessons learned. The early economic struggles. The Panic of 1837. The United States' first major economic crisis occurred in 1837, following the collapse of a speculative land bubble and the failure of banks that had heavily invested in land speculation. The Panic of 1837 was triggered when President Andrew Jackson issued the Specie Circular, an executive order requiring land to be purchased in gold or silver, which led to a liquidity shortage. The crisis resulted in widespread bank failures, a sharp decline in economic activity, and an unemployment rate that reached as high as 25%. It also set the stage for the rise of labor movements, as many workers found themselves struggling to find jobs and meet basic needs. The aftermath of the Panic of 1837 showed the lack of a national banking system and the need for more regulation to prevent speculative excesses. While the nation eventually recovered, this crisis revealed the vulnerability of the young nation to financial instability, particularly when banks operated with little oversight. The Great Depression, the catastrophe of the 1930s. No economic crisis in U.S. history is more infamous than the Great Depression, which began with the stock market crash of October 1929 and lasted through much of the 1930s. The stock market collapse was the result of several factors, including over-speculation in stocks, excessive consumer debt, and widespread economic imbalances. The aftermath was catastrophic. Businesses failed, banks closed, unemployment soared to over 25%, and millions of Americans found themselves homeless and hungry. The Great Depression not only devastated the American economy, but also exposed the shortcomings of the financial system, prompting a significant overhaul of government policies and institutions. President Franklin D. Roosevelt's New Deal, a series of government programs designed to provide relief, recovery, and reform, became a cornerstone of U.S. economic policy. The creation of the Social Security Administration, the Securities and Exchange Commission, SEC, and the Federal Deposit Insurance Corporation, FDIC, were key reforms aimed at stabilizing the economy and preventing future crises. This crisis was a pivotal moment in U.S. history, marking a shift toward a more active government role in managing the economy. The lessons learned from the Great Depression have continued to shape U.S. economic policy, particularly during times of financial instability. The Stagflation crisis of the 1970s. The 1970s presented a new kind of economic crisis for the United States, one characterized by both high inflation and high unemployment. This period, known as stagflation, was caused by a combination of factors, including the oil embargo imposed by OPEC, Organization of the Petroleum Exporting Countries, and rising wages. The oil crisis of 1973 led to skyrocketing fuel prices, which increased the cost of goods across the economy and pushed inflation to record levels. At the same time, unemployment remained high, particularly in manufacturing sectors that were being replaced by automation and overseas competition. The U.S. economy was caught in a difficult bind. Inflation was rising, but traditional tools to control inflation, such as raising interest rates, could lead to higher unemployment. The stagflation crisis challenged the prevailing economic theories of the time and led to the rise of new policies under President Ronald Reagan in the 1980s. His administration focused on supply-side economics, emphasizing tax cuts and deregulation to stimulate economic growth. The 1970s crisis also led to a transformation in the Federal Reserve's approach to monetary policy, with a stronger focus on controlling inflation. The 2008 financial crisis, the collapse of the housing bubble. One of the most recent and profound economic crises in U.S. history was the 2008 financial crisis. The roots of this crisis can be traced to the collapse of the housing market bubble, which had been fueled by reckless lending practices, including subprime mortgages given to high-risk borrowers and excessive speculation in the real estate market. Financial institutions that had invested heavily in mortgage-backed securities began to collapse as home values plummeted, leading to widespread panic. Major institutions such as Lehman Brothers failed, and the government had to intervene with a massive bailout plan to prevent the entire financial system from collapsing. The consequences of the 2008 financial crisis were severe. Millions of Americans lost their homes, unemployment surged, and the global economy entered a deep recession. The crisis exposed weaknesses in financial regulation and highlighted the dangers of deregulation and overleveraging. In response, the government implemented the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010, aimed at improving financial regulation and preventing such a crisis from recurring. The 2008 crisis also led to a reconsideration of the role of central banks, particularly the Federal Reserve. The Fed's aggressive monetary policies, including near-zero interest rates and large-scale asset purchases, helped stabilize the economy, but also led to concerns about inflation and income inequality in the long term. The COVID-19 Economic Crisis, a global shock. The COVID-19 pandemic of 2020 triggered an unprecedented global economic crisis, and the U.S. was not immune. The sudden halt in economic activity due to lockdowns, travel restrictions, and health concerns led to a sharp contraction in GDP, widespread job losses, and a spike in bankruptcies, especially in small businesses and the service industry. To mitigate the effects of the crisis, the U.S. government implemented a series of relief packages, including direct stimulus payments to individuals, enhanced unemployment benefits, and financial assistance to businesses. The Federal Reserve also took aggressive action, slashing interest rates and implementing large-scale asset purchases to keep financial markets liquid. Despite the initial recovery driven by government intervention, the pandemic has left lasting effects on the U.S. economy, including supply chain disruptions, inflationary pressures, and a rethinking of work and labor markets. Remote work, for example, became the norm for many workers, and industries, such as e-commerce and technology, saw rapid growth, while traditional sectors like travel and hospitality struggled. Lessons learned and future implications. The economic crisis of the United States have taught valuable lessons about the need for regulatory oversight, the dangers of speculation, and the importance of a strong safety net for citizens. Each crisis has led to significant reforms, from the establishment of social safety nets during the Great Depression to the tightening of financial regulations following the 2008 collapse. However, these crises also reveal the cyclical nature of economic instability and the challenges that arise when addressing the root causes of financial collapse. The 2008 financial crisis, for example, was largely the result of financial deregulation and risky practices, while the COVID-19 crisis demonstrated the fragility of global supply chains and the vulnerability of certain sectors to global shocks. As the United States continues to navigate the complexities of global interconnectedness, technological advances, and shifting labor markets, economic crises will likely remain a part of the national landscape. The ability to adapt, learn from past mistakes, and implement prudent policy decisions will be crucial in mitigating the impact of future economic downturns. The history of economic crisis in the United States is a tale of volatility and resilience. From the panic of 1837 to the Great Depression, from stagflation in the 1970s to the 2008 financial collapse, each crisis has shaped the nation's economic policies and left an indelible mark on its institutions. While the United States has demonstrated remarkable recovery and adaptability, these crises remind us of the inherent risks in an interconnected, complex global economy. By reflecting on past mistakes and embracing reform, the nation can better prepare for future challenges and continue to navigate the ever-evolving landscape of global finance. Thanks for watching. If you enjoyed this video, please like, subscribe, and hit the bell icon so you never miss an update. Drop a comment with your thoughts. And I'll see you in the next one.